To start this panel, I would like to welcome Chang Shu, Bloomberg's chief Asia economist. She will provide opening remarks on the economic and financial market outlook.
Good afternoon, everyone. It's a great pleasure to be here, and thank you very much for the introduction. I think the previous panel set a very nice stage for the discussion for this panel. I'm going to expand on some of the themes and put some numbers around them. And I very much look forward to listen to experts in the industry to see how the macro backdrop affects the industry. So I'll start by sharing three major observations. The first, on the global economy. In 2024, the global economy is likely to face a lot of headwinds in growth. And the major factors affecting medium and long-term outlook of the global economy, but I want to particularly expand on the theme of higher longer-term interest rates. And the second observation on the US economy. The US economy has been very resilient so far, but we still see the risk of the economy slipping into a recession. Finally, on China, the economy is showing signs of bottoming out, but the recovery has been relatively muted. We see the government continues to support the economy. If I may, to expand some of the themes, starting with the global economy, we just did our projection for next year. We see that the global economy will expand by 2.7% in 2024. That's a moderation or deceleration from 2023, 3%. We projected that. And it's going to be much slower than pre-pandemic growth of 3.7%. And out of the major advanced and emerging markets we cover, 1/3 of this will be growing below long-term trends. This group also includes the US economy and the Chinese economy, obviously the two big economies in the world. That means the central banks, for them, the focus will have to shift from inflation fighting to supporting growth and jobs. The second major trend I want to point out for the longer term for the global economy is indeed what Gillian talked about, this uptrend in the long-term interest rates. We have, Gillian put a very strong case, which I very much agree with. I just want to put some numbers around it. Bloomberg Economics did analysis assessing the neutral rate or R star on the 10-year US treasuries. And we see the neutral rate is going up by 1 percentage point in 10 years' time, in around 10 years' time. If we take into account the inflation trend, that means the nominal rate of 10-year US treasuries could be hovering around 4.5 to 5%. So that's not far from the current rates. And these longer-term uptrends in the interest rate will have major implications, triggering repricing in all segments of financial markets, equities, bonds, insurance products, and certainly the governments will have to be more careful how they spend. Now the funding cost is much higher. Then if I could move on to the US economy, the US economy has shown remarkable resilience so far. And through the third quarter growth, 4.9%, again, seems to be a reminder of that. But looking into the details, we feel some of the factors supporting the strong growth in the third quarter are one-off. Think of consumption, the kind of cultural phenomenon. You think about Barbieheimer, Taylor Swift, and Beyonce concerts, and that swept across the country and indeed across the globe. They lifted growth for the third quarter by close to 1 percentage point, and there's an inventory build-up supporting growth by another 1.3 percentage points. So those factors are not going to be there for forever, and indeed is going to reverse in the fourth quarter. Our team's assessment is that there's still a chance, indeed more than 50% chance for the US economy to slip into a recession by the end of the year, which will have implications for 2024. We don't think it's going to be a long, protracted, or deep recession, but a recession nonetheless. In terms of the Fed stance, the Federal Reserve, in its latest meeting in November, showed a less hawkish stance compared to September. The Fed highlighted the more moderated pace of job gains, tightened financial conditions due to higher yields. That seems to be a sign that the hiking cycle may be over. Yet, we don't think the Fed is going to be in a rush to cut the interest rates, perhaps in the second quarter at the latest. We think it could be later than the market anticipated. So all those will have very significant implications for the insurance industry. And just the final page, I come to China. China, and the headline growth appears to be strong. There's almost no question that, or no doubt whatsoever, the economy will hit the official target of 5% set at the beginning of the year. But that's largely due to the low base effects for comparison of in 2022, the underlying growth is pretty weak. Taking out the base effect, we think the true growth is just around 3% or so. That's clearly much, much below the pre-pandemic level. Many aspects of the economy will grow at this point are growing at well below pre-pandemic levels, particularly consumption. So going forward, the government is likely to continue to support the economy. There'll be something on the monetary side, perhaps another 20 basis points cut in the policy rates and more fiscal government spending on big projects and so on. But obviously, what is crucial for the government to do is undertake structural reforms and lift confidence. That's something fundamental to turn the economy around. So a lot of challenges for 2024, and I look forward to hear the industry experts to hear their thoughts on how this impacts the insurance industry. Thank you.
Thank you, Chan. Thank you very much. Your view on the economic and financial backdrop provides us with an opportunity now to deep dive and understand what this means for the risks to the global insurance sector. I am pleased, therefore, to welcome to the stage Lara Lilozian and her panel.
Thank you. Good afternoon, everyone, and welcome to the final session of the day. We do have a hard stop at 5:30. We've been told we could maybe go over 5 extra minutes, but not too much longer. So I want to thank you all for being with us for this last session. We're very aware that we're standing between this discussion and the festivities for tonight. Dr. Chang Shu and Jillian, they did their opening remarks really set the stage for the backdrop of the conversation that I'm going to lead on this panel regarding evolving risks in the global insurance sector. And the sector faces many risks. It's a bit overwhelming listening to Jillian, both financial and non-financial, but this panel will be primarily focused on financial risks. And I think for you all, hearing us talk about how these primarily financial risks affect the sector and what our supervisory perspective is, I think that's what you'll get most out of this panel, is understanding the supervisory perspective, what's top of mind, how we're thinking about these risks, what work we're contemplating. And I think that will help you better understand and plan accordingly as we head into year end and look ahead to 2024. I'll skip introductions. Maybe I'll just mention that I'm with the Federal Reserve, and I was recently appointed to the executive committee of IAIS earlier this year. And as she said, there's biographies available for our panelists. We have chosen these panelists specially for this panel. Each brings a unique perspective and risk to help us better understand and talk through the risks facing the insurance sector. And so maybe I'll just do a quick introduction. To my left is Marian. She's from Fitch Ratings. She brings that rating agency perspective. You all met Dieter earlier this afternoon at the town hall. He's chair of the Macroprudential Committee of the IAIS. On the screen, right behind me, we have Ronnie. He provides the industry perspective coming from Allianz, a large global life insurer. And we have Fundi to my far left here from South Africa. She's really providing a supervisory perspective, and as well as a perspective coming from emerging and developing economies. Now, some of her comments will be specific to South Africa. She's not representing all emerging and developing economies, but that is also a perspective we need when we're having this conversation about risks. Now, I structured the panel, and we're going to have to do this in a lightning round fashion because we've been squeezed for time. But I have structured the panel to mirror the macroprudential themes of the IAIS Global Monitoring Exercise, or the GMB. So you're getting a sneak preview of what's ultimately going to be in the global insurance report that will be published in a couple months' time. And these are managing interest rate, liquidity, and credit risks in a very challenging macroeconomic environment, and structural shifts in the life insurance sector, including the increasing move to alternative investments and the increasing use of cross-border asset-intensive reinsurance. And those two go hand in hand. And I have a number of questions, and then, time permitting, we'll try and open it up to the audience here to ask live, but we'll just have to, flex our agility muscles and see how we go the next half hour. So, Dieter, I'm going to turn to you to set the scene. Earlier at the town hall, you spoke a little bit about, what the Macroprudential Committee is up to, some of the work behind that. So we'll assume everyone understands or has a good working understanding of the global monitoring exercise. Maybe you could highlight some of the risks that you're seeing from that work as it applies to the insurance sector, highlighting both, the life and non-life, because the risks are different.
Yeah, thanks, Lara, and that'll be another challenge for today, how to be short. Let's say that I will try to avoid effectively repeating what I said earlier today, assuming that most of the people in the audience have heard that introduction earlier today. It's all in all a very challenging macroeconomic environment where we see, in particular, how financial markets remain fragile, how there is a lot of volatility, and that sparks a little bit the concerns which I've highlighted earlier on the impact and the interlinkages between interest rate risk, credit risk, liquidity risk, etc. And this brings a challenging environment for any financial institution, and that's very much also true for insurers. As I highlighted earlier, it's not all bad news. Increasing interest rates have shown a positive impact on both the solvency and the profitability of insurers. What I'd like to mention here is one interesting phenomenon we've seen on some markets is how increasing interest rates have also shifted the interest rate curve in some jurisdictions. And it was interesting to see how this shifted interest rate curve has also led solvency ratios to decrease. So the the natural linkage between increasing interest rates, so better solvency, was not always followed. And it brings certain challenges for the asset liability management of insurers when the interest rate curve isn't in its natural state of increasing rates across maturities. I've mentioned how that leads to certain liquidity challenges earlier. Maybe one thing I can add to that is that in particular in terms of surrenders, we have seen many interesting things, and there are a few things we like to zoom into, and that's something which we discussed also a few months ago when in annual global seminar in Seattle. That is the impact of an ever-increasing digital world of social media on the potential impact of that on surrenders. You know that in a digital world, communication can go very fast. We've seen how with certain banks in the US, for instance, that has led to very quick reactions. And the question is, could that also happen for insurers in case certain life insurance products would not be adequately be protected against those surrenders? So that is something we will dive into. On the fact that increasing interest rate risks could also trigger certain debt sustainability concerns, I can mention you that there are 4 items which we will particularly focus on. First of all, take a look at the credit quality of the investment portfolio of insurers. There is quite some diversity in that respect if you look at insurers across the globe. Commercial real estate exposures are a definite point of attention because we know that also with COVID that like offices are less in use in certain cities, and that drives commercial real estate prices down. Leverage in investment funds is a particular point of attention. And last but not least, the interconnectedness of certain insurers also to banks. And given a recent turbulence we have seen in certain debt markets, this pinpoints again, I believe, to the importance of this topic. Next to that, there are 2 other risks which I like to mention, which I didn't mention earlier. First of all, climate risk. I'm not going to elaborate on that because we had a previous panel who talked about protection gaps, and that's very much related to that. And last but not least, mentioned by previous speakers, operational resilience and cyber-related risks. And we know also here insurers are in a unique position. They can be the victim, let's say, of a cyber attack, but they also underwrite certain insurers at least cyber risks. So also on the underwriting side, insurers that underwrite cyber risk have an extra incentive, I believe, to try to understand that risk, and that's also valid for us supervisors. I hope I've been short enough.
Yeah, thank you, Dieter. Maria, maybe I'll turn to you to give an overview of what you're seeing as far as like the key risks in the financial markets.
Yeah, thank you, Lara. Dieter has already mentioned a few things that I wish we had longer time, because we could definitely talk about cyber risk and how that plays into in our analysis. First of all, I'm very grateful to be here. I'm not part of policymakers, regulators. I'm also not part of the insurance industry, so I consider myself a bit of an outsider today. But I hope that gives me some sort of unbiased position to share what we are observing and what we are focusing on at Fitch when it comes to the insurance sector. And usually we have a quite gloomy outlook because we are always looking at risks, not uncommon to you in the insurance sector. But I think there's also some good news here. First of all, a number of the risks that Dieter, actually all the risks that Dieter is mentioning are exactly the same risks that we are focusing on in reviewing our insurance portfolio. So I think that is a good sign. I would think that we're both focused in terms of prudential elements and looking at risks that we're focusing on the same ones. And I think the second bit that I wanted to highlight to you is that actually if our sector outlooks for insurance are, if you think about the life insurers, our sector outlook is actually neutral. And that means we don't expect it to get worse despite the volatility and despite the uncertainty that we're seeing. So yes, the rapid increases in interest rates create liquidity risks, margin calls on interest rate hedges or the policy surrenders. But for us in our portfolio, these risks are actually tail risks. So I think a neutral sector outlook for life insurance is considering some of the risks that we're seeing not a bad outcome. We also have, for the large majority, a neutral outlook for the non-life insurance sector. There is a negative skew to European non-life markets because the higher inflation increases higher expenses and claims, and particularly in the personal lines. We've seen some rating actions in the US also for this year, so that's a particular point of attention in the non-life insurance sector, if you like. But to wrap this up, within financial institutions, which is the area that I look after for Fitch globally, insurance is actually the most stable ratings portfolio. Famous last words. Let's hope it stays like that, because otherwise I'm on record here today. But 90% of our ratings in the insurance sector are on stable outlook. And actually the 10% that is not is kind of 50-50 divided between positive outlooks and negative outlooks. So I think that should give some comfort. So what are we currently watching? Just very quickly, because I know we have your other speakers. You want to comment on this as well? Market volatility and the higher rates are depressing asset values. And while higher rates are filtering through in better investment opportunities and higher returns, there is a lag in that. So that's something we're watching. The ability to raise premium rates to counter the inflationary pressure on non-life claim costs is important to watch, and that doesn't go in the same pace everywhere. The liquidity risk that we have seen, in particular in the higher surrender and lapse rates in life companies and how that transpires across different insurers. Actually, again, if we had more time, I would talk about the difference between what we've seen with the banks and the way deposits flew in that particular cohort versus perhaps more consumer retail-based decision making, but maybe that's for over drinks. And then for last, tighter financing conditions are affecting market access and refinancing costs. So when it comes to insurers, for example, raising sub-debt, I know there's a lot of attention to execution risk. What is the demand and what is the pricing going to be like? So perhaps looking at alternatives is important there. And then commercial real estate. You've heard it before. Life insurers are traditionally investors in commercial real estate. And if you allow me to, again, give some sort of perspective here, is actually we have done quite a bit of analysis on US life insurers and their holdings in commercial real estate. They have less than 5% of their investments is in CMBS, and 13% of their portfolio is in commercial mortgages. That is quite a lot, and it's actually higher than it was historically. It was between 8 to 12%, but it's been kind of stable year on year, so it's not growing from there. 85% are commercial. 85% are commercial loans, and 90% is actually in a low risk category of that. So the average LTV is 54%. So we think that risk is manageable. We think there is enough ratings headroom in the ratings that we assign for the life insurers to withstand that. And maybe I pause there with that bit of sort of balancing risks with the mitigations, if you like.
Thank you, Mariam. I guess I do take comfort in that you have a stable outlook on the insurance sector, because sometimes when we stack all these risks up together, it can feel overwhelming. Fundi, I'll turn to you. Given what Dieter and Mariam just highlighted and gave us an overview of the risks the insurance sector are facing, what are some practical steps that insurance supervisors are taking to ensure that insurers are properly and appropriately managing these risks?
Yeah, so thank you very much, Lara, and thank you, everyone. Unfortunately, I couldn't be in Japan. Let me sprint through a few points that I jotted down as Marianne and Dieter were coming in. Just to say that I'm assuming that most jurisdictions might be in the same position that we are in South Africa, in that it's often difficult to make changes to regulations themselves in response to some of the short to medium term risks. But where the leeway is in the supervisory instruments themselves and how one utilizes them. So in our jurisdiction, we certainly have focused more in having more intensive supervision. We have additional monitoring and analytics, better use of stress testing at a macro level, but also looking at individual institutions, but also doing some deep dives into portfolio assessments themselves, so that we could understand better how various institutions are affected, and following a broader risk-based approach. So let me touch on the first issue that's been highlighted, which is this issue related to high lapse rates. Now, in South Africa, we do have a unique situation in that we have had a precarious macro environment for the past 10 years, so we haven't had growth. So from a supervisory perspective, it's not only about this current growth period, but looking at what are the implications for our insurers of having had a long period of low growth, and what is different this time around. We do have high levels of unemployment, so as we are seeing the recovery from the pandemic, the recovery on the employment side is a lot slower. On the macro side, one is also seeing a dynamic where the volatility is coming through to us through the exchange rate. And there are other elements related to country risk premium, where on the short-term insurance side, these risks present themselves as more expensive parts, and so this has had profound effects on premiums as well. So I think that as supervisors, it is important that we have a broader structural understanding of whether we're dealing with short-term risks or we're dealing with longer-term risks that are embedding themselves in the system. So in terms of lapse rates, we are having more frequent supervisory meetings. We are seeing differences between our large established insurers and smaller insurers as well. So they do require a different approach. We also are seeing in the post-COVID environment also some differences between the life insurers and the short-term insurers. On the short-term insurance side, there are probably higher lapse rates because that is an area in which households in South Africa will drop first. We are seeing on the life insurance side more stability in that regard, and so this is what our observation has been. The issue that has been touched upon on what is happening to commercial real estate investments, we are looking at on a case-by-case basis, looking at individual insurers. What is very clear is that a lot of the insurers in our system are focusing on maintaining and managing the existing portfolio. There is not a lot of portfolio growth that is there that they are dealing with. Business models have come up as a big area that all insurers are looking at, and demographics are one element. So insurers are looking at their business model, they're innovating around the business offering as a response to the longer term low growth environment as well. I'm not going to talk too much about climate. We're not going to have time, but this is certainly an area that we are looking a lot more closely into as supervisors in South Africa. We're lagging behind, say, the European jurisdictions and other jurisdictions as a developing economy. So what we're doing this year is we have a thematic discussion with the insurers just to understand at an entity level how they are dealing with climate-related risks. We have had recent flooding in our economy, and there have been some learnings for us. But this is an area that has had the largest impact on the short-term insurers in terms of the claims rates. And so the interactions that the short-term insurers have had with reinsurance in South Africa has been fairly new, because reinsurance risk has been almost minimal for us in terms of climate-related risks. But with the recent flooding events, that is increasing more and more. One last point I want to make here as I wrap up is that What we should add to the list of risks that Dieter and Majan touched on is that there are also some country-specific risks. So in South Africa, for example, we have had the shortage of electricity. Now, that's a very South Africa-specific issue, but it has come through at this point in time. And the implications for reinsurance is that our reinsurers have said to us, there's no electricity, government doesn't seem to have a plan to mitigate the risk, and so we will be unable to. And so what we have seen is that the insurers themselves have had to reprice the risk, and also they have also had to restate what the terms and conditions around policies are. And this is an exclusion now, which was not the case for us a few years ago. So let me stop there, Lara. Too many things to touch on in terms of risks.
No, but that's a great overview, and a lot of what you said, the steps that you're taking in South Africa resonate with me in supervision at the Federal Reserve, both on the banking side, and we do have a small portfolio of insurers. I think the phrase you used was, intensifying supervision or monitoring, and we've definitely experienced that this year, particularly coming out of the spring and the events in the regional banking sector in the U.S. But yeah, this idea of ongoing and more frequent monitoring, particularly around surrenders, around liquidity risk, sensitivity analysis, liquidity stress, risk stress testing. I think all that's like fair play, and that you can expect to see that from supervisors, regardless of which jurisdiction they're from. There's that general state of heightened focus and awareness. Ronnie, I don't want to leave you out. How can you sleep at night knowing that there are all these risks out there and supervisors are focused on monitoring them? How are you managing some of the risks that we've talked about?
Thank you. Good afternoon, everyone, and I'm very glad to represent Allianz here in this panel. I think we at Allianz, I can sleep relatively well, right? Because it's all about preparedness, I believe. And in fact, we at Allianz, we are a global player, right? We are present in all type of insurance businesses, right? Life, health, property, casualty, commercial lines, as well as asset management, right? We are forgetting this, but I think we are one of the largest asset management player worldwide. And credit insurer as well, right? So this is really large. Having said that means that preparedness, again, is key for us, right? Preparedness and having a very robust and state-of-the-art way of managing all the risks that are related to this. I would just want to take just a few examples of some of the risks and how we are dealing with that at Allianz for now. So on the property casualty, currently, if I take since quite some time now, but it's all about inflation risk, I would say, to make it very simple, right? So basically what we are doing is, of course, we are looking at the level of the reserve, right? Monitoring the margin that we have in the reserve potentially, and then see whether with the different stress tests that the level of reserves are sufficient, but also to activate, I would say, a type of mitigation actions. Of course, it can come through pricing adaptation, right? We are talking about listening before about the protection gap, but of course, for us, it's one of the lever is to adapt the price in order to cope with inflation, which is relatively logical when markets are providing this possibility, of course, right? So that's on inflation. So stress testing, right? And this is a word I will use probably a few times, right? Stress testing in all dimensions, right? We have stress tests in different scenarios and combined scenarios, etc. And this is probably key to see whether our framework is robust enough, right? That we have enough buffer from a capital point of view, but also from a liquidity point of view. And this is something that we are doing. And for the inflation, it's about the reserve level, right? Another aspect that I think Dieter and Marianne were mentioning, and I would like to add on this, was everything around financial markets and the current market environment. It doesn't look like, of course, we are very rosy or really blue sky in front of us, and even the contrary, right? We've heard that also from Gillian, that's in fact before it was the outlier, and now we are more entering into a normal situation where in fact we have many clouds in the sky, and how we deal with that, right? So I take liquidity risk first of all, right? Liquidity risk, I think it's something that you need to test on a very regular basis. You need to put in place key indicators that help you to really assess the liquidity at each level of the companies and the group, right? And that is one aspect. You need to stress test the liquidity risk, right? To put you in a situation where you are forced to see, okay, what could happen worse, right? Lapse. For instance, lapse risks, right? And by the way, we don't observe a so significant increase in lapse risk in the different jurisdictions, maybe exception of one or two jurisdictions, but relatively calm, I would say, right? So this is something we are monitoring as well. But also we have what we call our strategic liquidity reserve. So to make sure that in any case that we have access to a buffer of liquidity that we could pull if necessary to cope with any liquidity shortfall that we may have in one or two business division, right? So that is one aspect. The other aspect I'd like to mention is, of course, for instance, the interconnection to banks, right? Yes, we have exposure to financial institutions, right? But in this financial institution, at least at Allianz, what we looked at is really that all our exposures are mainly based on covered bonds or loans where we have very high quality collateralization, right? And this is something that we really take care of. First of all, the exposure is not. We have a risk appetite that we put in place for all type of asset classes, right? And concentration, but geography, lines of business, etc. And this is something that we are monitoring. And when it comes to financial institutions, especially the collateralization, the over-collateralization, is something that we're looking at. And we are monitoring also over time to check the quality that it is remaining. Otherwise, we take some actions to restore the quality that we are asking, right? One aspect is the rising interest rates. Of course, it's the ILM risk that is attached to it, right? When it comes to a long tail life business, right? Of course, I would say there is one basic principle, and maybe I will end with this one, is don't take a bet on interest rates, right? You don't know what happens, and don't take a bet on interest rates. So this was our philosophy all the time, right? Since years, we don't take a bet on interest rates. This is as simple as that. We know that some institutions are maybe they have the tendency to think that they know better than market, right? This is not the case for Allianz. At least we are not that smart that we think that we can better anticipate interest rates movement. So that's why we try to reduce as much as possible the ILM risk, right? At any point of time, it is at a cost. Yeah, we know that, and we accept the cost, right? That's the burden for that. But this is the way we are managing it. So, in a sense, preparedness, stress testing, right? Robust risk appetite and very clear limits, right? And monitoring of that on a very, very, very regular basis. That would be maybe the few points I would like to highlight there.
Okay, very good, Ronnie. I can see based on that how you can sleep better at night. Some of the stuff that you were saying around liquidity risk, it also resonates with me reflecting on this year and the interrelatedness of it all. Like, I think, this year more than ever, for me, based on my experience in the US, really brought together the importance of being able to manage interest rate risk, and how that connects with managing your capital, managing liquidity risk. Of course, there's underlying accounting issues under all that. And, you know, part of my role at the Federal Reserve is as chief accountant. So you can't have a discussion on one of those risks in isolation. They're all interconnected. And I could hear that in many of the comments that you guys made. Some of the items you highlighted sort of segues nicely into the second round here. We're going to do this lightning round. Dieter, you had mentioned, you know, part of the macro prudential themes from your global monitoring exercise was the structural shift in the life insurance business to alternative investments and increasing use of cross-border reinsurance, asset-intensive reinsurance. And so, you know, part of how I understand the basic narrative around all this was, for so long, insurers were operating in a very low interest rate environment. What did Jillian say that? I think I'm going to try and borrow that going forward. She was drunk, you know, we've been drunk on liquidity for so long. And so insurers over time had to seek higher yield investments. And as a result, they've allocated a greater portion of investments to alternative investments. So I heard many times commercial real estate. I don't know if you all have access to your Slido. There's a polling question related to this. Okay, here, yes. So which assets fall under the alternative assets category? And sometimes it's challenging for us to have this conversation because there isn't a consensus definition of what alternative assets are. You might know these as high-risk assets or other assets or non-traditional assets. So if you tick all the ones that you consider to be alternative assets, and we'll see what comes up. But my guess is it'll show us, you know, how difficult it is to have this conversation because there is no, oh, interesting, real estate. Okay, yeah, okay, that makes more sense. I guess, Maria, maybe I'll start with you. What kinds of trends are you seeing in the alternative investment space?
Yeah, I think if I look at that long list, I would say I wouldn't probably necessarily call all of those alternative investments. I think that the areas that I would focus on, and yeah, I would say, okay, definition is important, but I think it's also important what are the risks you're trying to look at. And I think for me, there's two elements. I think the private element can be, is something that needs to be on the radar. Anything that's private usually has less visibility or less transparency, less disclosure, also usually is less liquid. So I think that is something to bear in mind. The other element is the word structured. I think we're seeing more structured assets being invested by life insurers, and I think that's a very wide range and can be quite complex to really understand. So I think from my perspective, from our perspective as a rating agency, those understanding what is in a structured product, whether that's a securitization or whether that's a fund that invests in all sorts of other assets that gets then a rating on it, I think you need to really look beyond the surface for that. So I think that's important to me. Then what are we observing? It's definitely, as you mentioned, it's probably born out of the low interest rate environment. But I think it's not. We don't think this will stop actually. And we have the best data really in the US. And to give you a bit of illustration there, so the private credit in the US grew by about 750 billion, a 13% CAGR from 2012 to 2022. That is 12% of the nearly 6.3 trillion US commercial credit market, which is the banks, loans, high yield bonds, and leveraged loans. So that's really grown a lot. So there's more opportunity to invest in that, right? So it's only natural that I think that life insurers who have a need for investing in more credit, they take a part of that. But where I think things might start to diverge is when you talk about the tie-ups between alternative investors, alternative investment managers, and life insurers. And we've seen, particularly in the US, we see that they are now having on average like 19% of exposure to private credit, and it's 4 times more than life insurers there that do not have that tie-up. So I think there are some different trends that are worthwhile looking at there. Overall, they have grown 8% every year in their exposure to private credit versus the US life sector overall only 0.6%. So we would say overall the growth has been quite in trend with what's been happening in that market, and it's not necessarily an overexposure, if you like. But as I said, you have to really look at, I think, the differentiations there. And what would be for us on the credit risk is private credit borrowers are generally a slightly weaker credit quality. They have higher debt service burden, and they also face probably a little harder from the macroeconomic headwinds. So we do expect that the quality of those assets are deteriorating in the current environment. That all being said, again, we don't think at this stage that that would put a rating pressure on the life insurers, because again, we feel that risk can be managed quite well with strong asset and liability management. But the last point I want to make here, because it is growing and there is a credit negative element about it, and it's coming back to my first 2 points, is less transparency, less disclosure, less liquid, and more complex. And I would really say that's where the homework lies.
Some of your principles are analogous to Dieter. Maybe you can speak more about this, the principles that we use at IAIS to describe alternative investments. But you hit on, there's greater complexity, harder to value, less liquid. I mean, Dieter, maybe I'll turn to you. You can give the audience a sneak preview of what's going to be in the GMAR report in terms of, next steps, our focus in this area.
Well, it's a very interesting topic, and as we've said, life of life insurers hasn't been easy, and the experience is whenever you're drunk on liquidity, it's the day after that hurts most. And I think we're a bit in the period the day after where you see that interest rates have been increasing. Now we approach really as I said earlier, these two sub-themes. The first theme is the one we have been elaborating on the alternative assets. I think two things which I would really like to highlight is, first of all, the observation that when you talk about alternative assets and you ask two supervisors, what do you understand is an alternative asset, you may get different responses. So that's the first thing to do at the level of IAIS, is try to find and to see if we have common principles to define what is an alternative asset. It's a bit a pity that we don't have the polling results, by the way. We could have maybe illustrated it with how the audience is looking at alternative assets. Here we are, thank you. So this gives you already an illustration of how looking at alternative assets or trying to define what is an alternative asset is not a trivial task. What we also try to do is actually map the benefits and the concerns that come together when we see insurers increasing their exposure to alternative assets. There are benefits to the extent that usually these assets tend to be longer dated, so they match better the longer dated liabilities. They allow insurers to better diversify, invest more directly in the real economy, contribute to providing credit. The concerns I think I've mentioned earlier today, it's not always easy to value those assets. They are not always transparent. There is not always a secondary market that is very liquid. So it brings a little bit together also the theme we discussed earlier, and we've hinted, for instance, towards the liquidity risks. Now, the other part of the structural shifts in the life insurance sector is the asset-intensive reinsurance and the growth in these type of transactions. The challenges we observe here as supervisors are, first of all, the observation that they tend to be concentrated, these transactions, in certain jurisdictions and for certain business models. And sometimes we see that, or we have at least a feeling that they are set up to benefit a little bit from differences between jurisdictional approaches, between regimes. Differences in terms of valuation, capital requirements, reserving, and that's where sometimes as supervisor, of course, you get concerned. They are often cross-border in nature, which makes them quite complex to understand. And really here, there is a need for more transparency, and we'll be working on that also at the level of IAIS to trying to better understand these transactions, to try to see what is the driver of these transactions, to facilitate information exchange among supervisors. And ultimately, this also brings us, I believe, to the question, why are these structural shifts happening in the life insurance sector? And I think it's very important to try to find an answer, both as supervisors, but also as an insurance industry, as to why life insurance in certain cases has been struggling. What are the challenges? Where can I bring added value as a life insurer? Because we have been highlighting already today, again, the importance of trying to fill the pension gap. And life insurers will have a key role in that. And whenever you see structural changes happening, it's trying to understand how these structural changes can help us in filling these pension gaps and both the benefits and the concerns that come with that.
Thank you. Thank you. And thank you for being balanced in your view too, because you did highlight some of the benefits of, the shift. I'm sure Ronnie would appreciate that as well. But there are risks that, we're going to be monitoring. And so you've summarized that very nicely. We are pretty much at time. I wonder if there's anybody in the audience that has a question for this panel real quick before we wrap up. I wish we had more time to get into this because there's so many questions, given the changing macroeconomic environment, what that could do to this structural shift, what do higher for longer interest rates do? But I don't know that we have time to get into all that. Any questions from the audience? And maybe you can take Marian up on her offer to talk about some of this over a drink over the next day and a half or so. I saw a hand come up over here on this side.
Hi, it's Hugh Francis from Aviva. Dieter, it's an interesting discussion about what do you mean by alternative assets. Just to understand what the concern is, because it strikes me that if you look at a lot of those investments like debt, they look about infrastructure assets, they're actually the very assets that when we start talking about climate are the very things that actually their expectation is those are the things that we as insurers should be investing in. So is it the assets per se, or is it the risk management or the understanding of the assets that would be helpful to say? Because I don't think an asset is necessarily good or bad. It's a question whether it's appropriate to your business and whether you understand. But it'd be interesting to know how you're looking at that.
Yeah, I think you summarized it very, very well. It's really about when you see growing exposures in any type of asset class, the first thing you want to do, I think that's both true for insurers and supervisors, try to understand what happens and why is it happening. And we see some challenges in terms of valuation, as I said earlier, in terms of potential less liquid markets, but it's could be also the natural habitat for insurers with their long-dated liabilities. And as you say, to some extent, insurers are well placed to contribute to these markets, and as it fits very well their asset liability management. What is important, I think, is whenever you introduce a new asset class in your investment portfolio, is that you have the adequate understanding as an insurer, the adequate risk management, and I talk about credit risk management, asset liability management, and liquidity risk management. And I think for insurers, it's important to make sure that supervisors are getting a good feeling and can sleep well at night as well when they see how the risks are dealt with in terms of risk management. And an additional challenge, I would say, for us is trying to map the macroprudential aspect of that. So trying to map the global trends and see what it means if we add all these individual decisions of insurers on a macro scale.
Yeah, go ahead, please. Yes.
I really like the way both of you put it, like understanding why. Why are certain products being structured? Why are certain investments being made? And I would agree, often it fits very well. But understanding the why is the first, I think, answer to understanding the risks. And I think we do that a lot as well. So why are we being asked to rate this? Why? And particularly in times now that liquidity is drying up, right? Stuff is shifting. So ask why.
Yeah. That's it's a great note to end on, I think, to ask why and to be prepared. Just 1 minute left. If I can each ask you, heading into year end and looking ahead to 2024, what is absolutely top of mind, highest priority for you? Just give it to me in like a few words. Ronnie, let's start with you.
Thank you. A pleasure to have the conclusion words here at first. I think again, I think preparedness. I think we see all the clouds on the sky that are accumulating, but I think that we will see how resilient companies are, and we believe we are resilient, right? We test our framework and we test our approach in the past, and still today and tomorrow we will do. And maybe a final word. I mean, I agree to say that on some assets, it's all classes. It's all about the how appropriate they are for the business that we are proposing. Right? It's not just complexity. We need to cope with complexity, right? And means that we need to continue to strengthen our models. To strengthen our understanding and having a deep understanding of that, right? And it means that we need really strong capacities, technical capacities to cope with this complexity, right? So I think it means that more model, more parameters, better understanding on the interactions between the different markets, and I think this is probably a key for that, right? Sorry. That was a bit long.
Fundi, what's top of mind as we wrap up here and we look ahead to 2024?
Yeah, so pretty much what was asked by the person that I couldn't hear very well, except understanding the why and is the key to understanding the risks. Certainly for us, strengthening the risk management frameworks at an institutional level, having stronger and more diverse boards who have seen a bit more of the world, I think that's going to stand all of us in good stead alongside the analytics. Let me stop there.
Okay, great, thank you. Mariam, Dieter, do you have anything more to add in terms of top of mind, top priority? I feel like
I would say continue down the path we're on, increase our understanding, trying to make sure that if ever we need to take supervisory measures, that they are aligned, comprehensive, and in line with the risks that we see. And I think that's the challenge for us as supervisors that we will try to continue to achieve.
I would say there's no particular theme, but I think understanding interconnectedness and finding where the next shoe is going to drop so that we can be prepared. And I think that remains a big challenge. And if I look at the last 3 years, March was always a bad month. So I'm a little worried about March. If I can predict this year what's going to happen in next year, March, then maybe I can be better prepared.
I can very much relate to that. I can very much relate to that. Well, thank you to you all for joining the panel and for making time to speak with us. Thank you all for sticking with us. Very much appreciate this opportunity and hope you enjoy the rest of the evening and tomorrow as well. The conference is a great opportunity for everyone to connect and to learn from each other. So thank you all.